Hi, everyone. Welcome back to The Lens, your favorite financial podcast. This week, again hosted by Craig Shapiro and Larry McDonough, and a little special guest we'll bring later on. Remember, we're here to help you guys, we're here to assist you. We're going to talk about all the things that happened this week. What are we seeing? What's moving, what we're afraid of, and you would like to know everything. If you're interested in joining the Bird Shops Report at any point, remember you can reach us at info@thebirdshopsreport.com. We're looking forward to hearing from you. Craig, Larry, go ahead, guys.
Valentina, thank you so much. And the entire team in New York, Jose and the team, thank you very much for setting this up. Craig, it's a sad day. We're after 4.5 years, we're exiting Barrick Gold today. I mean, a year ago, these gold miners, everybody was bearish, right? A year and a half ago. And now this, from what I understand, we run a Bloomberg chat. Craig and I run the Discord and the Bloomberg chat with hedge funds, mutual funds, and pension funds in more than 20 countries. Special thanks to Bloomberg there. And we triangulate information. So we're talking to the smartest investors in the world live during the day, and we're kind of democratizing that information with high net worth individuals, family offices around the country as well. But yeah, so Craig, there's a lot going on around this month end, quarter end. You have some interesting anecdotes that you've been hearing from clients.
Yeah, so today is quarterly options expiry, a quad witching event, futures roll, single stocks roll, everything kind of rolls today. And what we've noticed historically is that these quarterly expiries often act as transition points where markets, can turn from one direction to the other. What winds up happening structurally is that a lot of dealer positioning and option positioning comes off the board today, right? A lot of that comes off at 9:30 in the morning. The rest of it comes off at 4 o'clock in the afternoon. And so, dealer levels and street level gamma and a lot of things that kind of drive the daily options activity just are diluted starting the end of the day today and into Monday. What that means is that, the possibility or the probability that fundamental data points, macro data points can overwhelm this consistent zero data expiry option activity that we've been seeing, the probability that could happen is amplified. And so as we move into
and Craig, how big is this? Is it really 5.3 trillion?
5.3 trillion of expiry, 3.5 trillion of that is already off the board at 9:30 this morning. That's in your SPX, if you ES, but the rest comes off at the end of the day. So yeah, it's a major flow. I mean, every stock that trades options, they all trade today. So and basically any stock with an option is a zero data expiry option today too. So just massive option volume today. But starting Monday, a lot of that gamma profile starts to go away. So what we wind up happening is, the rest of the quarter, we have some fundamental things that are going on after the Fed meeting this week. That could become more important. A Fed that maybe didn't deliver the degree of dovish expectations that the market was pricing in. I think that's going to start to matter more for equities as we push through the back half of the month. It's already mattering for the dollar and for rates.
Well, Craig, one of the guys who I really respect, CIO from London, the moment after the Fed meeting, he says the hard asset game is now going to a new level. And, his point is around the Fed, essentially cutting rates with inflation bouncing.
Yeah, but it was a hawkish Fed meeting versus expectations, but it was a dovish decision, right? Basically, the Fed decided to recommence the cutting cycle, despite the fact that it is upgrading its estimate of GDP, it is upgrading its estimate of inflation, and it was actually downgrading its expectations of the unemployment rate in 2026 and 2027. So why is the Fed cutting rates into that environment?
Craig, for the love of God, right? I mean, Beth Hammock, who I really respect, I've known the Hammock family for a long time, Cleveland Fed voter. Clients are guessing she wants to hike. There's one hike in there in the dots. And so you have one governor that wants to hike rates. And then you have another governor in Marin that wants to cut rates 150 basis points. I mean, that's Zimbabwe type stuff, right? That's something that you don't see from a U.S. central bank, that kind of divergence.
Yeah, I was just going to say that the divergence is wide right now. And Myron was just on CNBC, and he's going to give a big. He said he's going to give a big presentation on Monday, which really goes through his views. He feels like he's obligated to show his independent thinking, and he is not a shill for the administration. But immediately when you come out, expecting or suggesting 50-50-50, to largely get to below neutral by the end of the year, you really got to start to, come out and justify that. And he's basically saying, if the productivity gains are in, there's no impact of tariffs on inflation, the rents are coming down, and there's a lag impact of that. And so it's really all systems go on the inflation side. And then as the labor market is deteriorating, Fed needs to be more aggressive sooner. That's his view. To your point, on the flip side, you have President Hammack, and then governors, Schmid and Mussolem, who are much more hawkish, much more concerned about a sticky inflation environment, and actually, raising the expectations for inflation, core PCE up to 2.6%, and kind of, really talking about it could be quarters, if not years, before it's proven that this tariff inflation is transitory. So a very wide divergence on the Fed right now, which I think suggests more, and Powell kind of articulated this to some degree. It suggests a more gradual pace of easing to the neutral rate versus what is being priced, or what was being priced by the market. The market was looking for rates to move below 3% by the end of 2026, which would be accommodative financial conditions. That would be a Fed that's accommodating, despite inflation, that's really not going back to target until 2028.
Right.
So I think Powell downshifted that expectation a little bit. The equity market hasn't sniffed that out yet, but if you look under the hood, I think what you're starting to see today is you're starting to see some stalling out of meme stocks. We've been noticing transports have been underperforming now for several weeks. Regional banks topped out a few weeks ago. Some of the domestic, more cyclical and lower end of the K-shaped economy related stocks have been picking up some of this slowdown dynamic. And so I think as we push through next week, as we kind of reopen this potential window of weakness, I think broader equities are going to start to follow where the dollar has been rallying and how rates have started to move higher again. I think stocks are going to start to notice that.
And look at the move into hard assets here. We provide trade alerts for clients real time, and as you can see, we've been in the Barrick position for years. But at the end of the day, in our book, How to Listen When Markets Speak, a top 10 on Amazon all week, all year. The thesis in the book is really simple. There's too much money in financial assets, not enough money in hard assets. When you have a 27 multiple trillion dollar debt hole, right? You're really in a financial repression area where they need to get interest rates below the rate of inflation. They need to massage interest rates. They need to come up with reasons to cut rates to try to get interest rates below the rate of inflation. That way you can kind of inflate your way out of that, colossal debt hole. And, I just think with the rebalancing on the month end, quarter end, there's something going on with Barrick today, Craig, where I think there's a month end, quarter end rebalance where people are being, like, some indexes are being forced to buy this stock, or people are front running it into next week, the rebalance. Are you hearing that?
Yeah, I think that there seems like there's some of that. I mean, look, we're finally getting it's been a while, right, since gold stocks have really kept pace with the gold price momentum. And I think, as oil prices continue to fall and the gold to oil ratio continues to explode higher, that's a margin expansion sweet spot, right, for gold miners. And so folks have realized how much leverage, how much operating and financial leverage these gold miners have to a stable and rising gold price. I mean, every day that goes by and gold ticks 3,600 plus, these guys are minting money hand over fist. And so as we're seeing some of the rotation out of other areas of the market, whether it's the tech story or other cyclical areas, people looking for earnings acceleration stories. I mean, gold mining is right in there, and
Right.
It's hard to pick that up in the S&P. I don't believe there's. I think maybe only Newmont is even in there. I'm not even sure if Barrick's in the S&P. Maybe that's the thought. Maybe that's the thought here, is that they'll be added. I'm not exactly sure on that, but GDX, clearly there can be some just kind of sectoral flows out of other ETFs and into GDX and GDXJ. I mean, that's I think we're getting a fair bit of that dynamic.
Yeah, we made the point maybe a month ago that retail just doesn't own these stocks, right? They don't really own hard assets. And as you can see here, Sibanye, platinum, palladium, so the entire market cap of gold, is up near 20 trillion. All the platinum and palladium ever mined that's above ground is like $300 billion. So it's a joke, right? So $300 billion versus 20 trillion. So what we've noticed is these, kind of tertiary metals are starting to outperform dramatically, and that's kind of a big story. And here you can see the Impala, same type of story, where that money's moving out of financial assets into hard assets. It's a big theme in our book. It's playing out, and that's the first thing in a commodity bull market. You've got the gold move, you get the precious metals, the metals, and the next stage is the ags and then energy, right? So we're in that first stage where you're in the metals. Next stage, agriculture, and then energy, and that's the way we're kind of we're actually taking down gold miner exposure and adding to some of the gas names here in our high conviction portfolio. Next slide. So Craig, in terms of one of the things I want to get into is some of the price action this week. Very strange. I think this is the Nikkei, big candle, like a 3% move overnight in the Nikkei. So the Japanese equities. Are you hearing anything over there? You've got breakout yields globally again,
Yeah.
almost.
Yeah, look, I mean, there was a BOJ meeting last night, and they finally, and this is incredible, but the BOJ owns a tremendous amount of the Japanese stock indices, through ETFs, and they announced that they were going to start selling down some of that position. It's going to take them 125 years at the current rate to sell down their exposure. So I think people got a little bit freaked out that they said they were going to start, basically effectively QTing some of their ETF holdings, but it's a de minimis size. But look, again, it's expiry week and a lot of crazy price action going on. And so there was a big intraday reversal at the highs in Nikkei. Both of the candidates for the new prime ministership are talking about budget deficit expansion in Japan, and so you had
That's what's driving hard assets.
Absolutely right. So that's the story globally. Is you have here's a second chart here of Japanese 10-year yields basically breaking out. I think I saw something to 17-year highs today. You have yields in the UK breaking out. You have yields in Germany basically breaking out, and across Europe are breaking out. It is budget deficit expansion is becoming really a global phenomenon, right? It had been largely a U.S. phenomenon for years, and certainly through the early parts of COVID, as the U.S. broadened out its deficit expansion, other countries were a little bit slow to do that. Now they're ripping the Band-Aid off, right? And Trump is pushing that direction because of the way that he's talked about forcing them to spend more on defense. But it's even more of just a domestic consumption story, domestic infrastructure story, and build out, and it's across the board, and that's the global long end of the yield curve here. And what we've noticed and what we've seen after the Fed cuts rates 25 is, lo and behold, long end yields are higher, right? And so this was the talk into the Fed cut, and this happened last year after the 50 basis point cut. Back end yields kind of moved materially higher. Was that going to happen again? Most people thought that it really may not happen, but so far, 3 days in, we're seeing it. But I think it's less driven by the Fed per se, and more driven by some of the stuff that's going on globally with this deficit expansion. So this is a big theme that we got to keep our eyes
Craig,
on.
Think about everyone just sit back and think about something. There's not one human being on earth that's long duration in Japan, in France, in the UK, the US. Anyone long duration, like long-term bonds, like 30 years, more than 20 years, 10-year bonds. Every one of those people is losing money since 2021, 22, right? And you can see how much the yields have gone. So what happens is every minute, every hour, every day, every week, every month that people are sitting on these bond losses. That's what's driving. That's what's driving money into hard assets. And we saw this in the 70s and the 80s. But remember, people forget. Like, we've only been in this for a couple of years, like 2-3 years. But people have been consistently losing money on duration, and that's moving money into hard assets. A big thing this week, Craig, was the restaurants. Now, is this a consumer thing or a margin thing? Because this is a big divergence here and Darden. I've met the Darden team over the years. When I was in Lehman, I was at a number of conferences with you. These guys are great operators. You know what I mean? They don't usually get body slammed by data, right? What's happening here?
Yeah, Cracker Barrel also I put into that bucket. They reported this week, kind of worse than expected top line momentum. I think this is a low end consumer, story. This is the lower part of the K-shaped economy continuing to be squeezed. This is consumers who
So
are.
you're in the consumer side. You're not saying it's a margin issue because of food costs.
Yeah, look, I think this is because you're seeing it. I think in more than just Darden, right? You're seeing it kind of across the board in some of these lower end retailers, lower end restaurant names, and so I think that's really where it's showing up. I mean, the low end consumer getting squeezed by medical costs, insurance costs, utility costs, and just his discretionary budget continues to be pressured. Wage gains are not particularly robust, and so I think that is that's the story there, and broadening out. I mean, I think at any individual quarter, these restaurants report margins are the story, but I think the broader trend, top line momentum, is decelerating across the space, and it's just an area that folks don't want to really be overly exposed to.
And Craig, so a big theme. Remember, once again, we're talking to the smartest investors in the world in more than 20 countries, hedge funds, mutual funds, and pension funds. What really kind of wakes me up a little bit is and makes me kind of like the hair in the back of my neck move up is when 2 to 3 or 4 people that don't know each other are pointing out the same thing to me in the course of 2 days. And that's on the business development companies. So think of private credit. So in the old days, banks did a lot of this lending. Now there's over trillion and a half dollars in the private credit space. And these companies like this KKR offshoot here, these companies are lenders to triple C rated companies. They're not rated, they're more like triple C quality. So think of software, right? And this is a big new theme that I've been hearing over the last month, and I'm hearing a lot of it this week. So look at say CRM stocks, 35% off the highs with equities at all times highs. So that $2 trillion, Craig, of capital expenditures that are coming at software companies. So all this artificial intelligence, and that's what CRM equity is telling you. And now we look at companies that are in the private credit lending space that have lent a lot of money to software companies. Software companies, Craig, were like the creme de la creme, like the steady cash flow, right?
The SaaS model, yeah.
Yeah, what are you hearing on this private credit space and this weakness in some, and this is across the board in these tertiary financials?
Yeah, this is a little bit of the 1 + 1 + 1 = 100 type stuff that I think we're typically good at aggregating, right? And so we started to notice this over the course of the last couple of weeks. There was that Tricolor ABS auto bankruptcy a couple of weeks ago that some of our smart clients were kind of pointing out as hey, that's weird, right? Like why, like what's going on there? And then more so this week with some of these tertiary credits and these BDC credits and this private equity. We know how much money has plowed into private credit as largely, banks have decided to really not move and lend into some of these more, asset heavy areas. And so, look, I think this is what happens at the beginning of turns in the economy. And as the labor market has shown more signs of decelerating and deteriorating, credit is starting to become a little bit more strained, right? And so the places that are, it's kind of last in, first out, right? The private credit was that real last reach for yield type dynamic with some, worse than expected credit fundamentals. And so as the economy starts to show a little bit of signs of strain, particularly anything that's in this AI CapEx related area where the profitability model is starting to be questioned, right? Is all this spending going to really create return? And we know that the hyperscalers and the rental parts of hyperscaler yields are already starting to be pretty bad. So, as the economics start to get challenged, people who have lent in last at poor rates of return are the first ones to suffer, right? And so I think that's what we're starting to get there with some of the tertiary financials. Is this going to be a systemic problem? We don't know yet, and I think that's the question. I mean, with bank, I think Citibank. I think you had a lot of people have been talking about Citibank. I think it made a new high this week, right? So it's clearly not showing up yet in the big banks, but that is the transmission mechanism, right? You start with tertiary financials, we move into then we move into regional banks, and then we move into the big banks, Craig, right? And so that's what we'll be watching.
I mean, this chart is the mind blower of the week, right? So this is Citi, the percentage above the 200-day moving average. So there's 7,200 days over the last, I think, 20 years. One of the clients put this in the chat. Something like 7,200 days of the last 17 years, something like that. And only 240 of those days has Citigroup been here. And that's close to 30% above the 200-day moving average. So once again, yeah, it's like people are afraid of they're afraid of the tertiary financials, but everybody's still piling into the to the mothership, the large cap financials.
And I think that has a lot to do with this passive dynamic and options dynamic, and where we are in the month relative to options expiry. And what I would say is, what you used to be able to do is you used to be able to look at some of these more esoteric areas, the tertiary financials, and then say, all right, I know how this is going to filter through the rest of the financials and then the financial system. Let me be ahead of that by shorting Citi now, right? But because of all these other factors that are involved with respect to it's weighting in the XLF, and then the XLF's weighting in the S&P and stuff like that, sometimes it just takes longer for that transmission mechanism to actually play itself through. It's almost like if you see the tertiary financial weakness, you should just, if you want to be negative, just stick with that. You don't need to be making second and third derivative trades yet, right? Until we start to get more correlated moves and more beta moves, then you can say, okay, I know financials are exposed because I'm seeing it in the worst financials. Now that the market is overall showing some sort of weakness, now I could press the financials short, in the big guys, because they're going to be the ones that are exposed, that people are broadly looking to get out of financials because of, the tertiary financials have been struggling.
Right. And so I'm sorry, we're jumping around here because we threw this together pretty fast, but just back to hard assets. This slide should have been, up at the front. But once again, long duration equities. We talk about this in the book, How to Listen to Markets Speak. If you have $1 billion of cash flow that comes to you over 10 years in a deflationary world, that cash flow and those types of companies are in much, much better shape. But if you have $1 billion of cash flow that come to you over 10 years in an inflationary world, that cash flow is decaying in value. You're getting back less cash. So that $1 billion over 10 years because of inflation is getting eaten alive. And so long duration equities, like software companies, are really struggling relative to hard assets. Now, some people would say, well, this is artificial intelligence coming after this space. I also think there's a large part of this that's long duration equities up against hard assets and inflation.
Yeah, no, I totally agree. I mean, the hard asset trade is a bit of, has a lot going for it, right? It has the dollar weakness component going for it. We know the administration is tolerant and supportive of structurally devaluing the dollar over time to reorder global trade, to bring back manufacturing jobs, and to reshore in America. So it wants a lower dollar. And so, being on the right side of the administration is very helpful, and commodities as an asset class are going to benefit from that. And then similarly, it's going to benefit from demand acceleration trends as we build out the power grid for AI, as we rebuild, geopolitically, tensioned areas like the Ukraine or the Middle East or what have you. And it'll benefit from the fact that supply growth is not accelerating because the CapEx into these areas has just been so depleted because, cash flows have been poor up until the last couple of years. And
right.
So kind of a perfect, a perfect start. Look, when you have these breakout moves, doesn't mean you got to buy them every single day. Doesn't mean we can't have, checkbacks along the trend. But, as we get alleviation of overbought, we're going to be, happy to be adding exposure.
And Craig, thanks for that. One thing I want to make clear on the BDC space is the blue owl situation is fascinating because private credit has grown so fast in recent years. There started to be offshoots and kind of specialty lenders. So these guys at Blue Owl, their specialty is software and tech, right? Mm-hmm. So they're lending to companies with literally no EBITDA, no free cash flow, really companies that are, like I said, triple C type companies, maybe single B, lower credits that are in the tech space. And that's why, if you notice here, that Blue Owl versus JP Morgan, you have substantially more underperformance here because they're a lender into the software space.
Yeah. I mean, that makes a lot of sense. I didn't realize that. That's a great catch by you. Yeah.
Yeah. There's a number of clients have been pointing that out. And then, so the Blackstone, once again, private credit, business development companies, right? So it's $1.5 trillion, $1.25 trillion of lending out. Like this is almost like shadow banking all over again, right? That we talked about in our first book about Lehman Brothers. But as you can see here, market at all-time highs, bull market, and lo and behold, the Blackstone BXSL in flames, like literally in flames this week, making new lows. I mean, it's something's going on. Like the tertiary financials are telling us something.
Yeah, look, I think this has to do with a view about where is the economy heading, and there's a split camp here. I think the labor, there's many people, including myself, who have been saying we're concerned about the labor market deterioration. That seems like it's getting worse. It seems like AI is going to continue to make hiring much more constrained going forward as companies are, waiting to see. And so if we get more layoffs and the economy continues to slow, it's going to lead to a more of a troubled area. And I think some of the financials are sniffing that out. On the flip side, there is a group of people who are saying because financial conditions are as loose as they've been, the stock market is at the highs, wealth effect is incredibly robust. We have this AI capex cycle that's going to lead to reaccelerating PMIs globally, global deficit spending in Europe and Japan and China, and we're about to have a reflationary boom. Right. So we're, that camp of are we slowing or are we, accelerating is being debated. I think the Fed came out this week. Someone was asking about the Fed meeting. I think the Fed came out this week, tolerant and acknowledging that the U.S. economy, labor market deterioration is slowing down. And so they want to be kind of trying to get ahead of that. But then the 10-year yields, which is the question, the yields are starting to move higher because it's not clear that we're really slowing that rapidly, right? If the new rate of labor of job gains in America, excuse me, after immigration is only in the 25 to 75,000 range, we're really not slowing all that rapidly. So,
right,
with those other inflationary pressures from deficit spending, the global long end yields are not falling. So, I think we're in that kind of camp right now where the next few weeks of data will really be important for folks to kind of get a better understanding of what's the pace of economic deterioration or reacceleration. And look, we're getting some early signs on earnings. Excuse me, sorry, but with go ahead. I got to.
It's okay. I've been there, buddy. I've been there. All I can say is it's month end, quarter end, Rosh Hashanah, early next week, and then Yom Kippur the week after. What's the old saying?
There's
what's the old saying?
There's a sell Rosh Hashanah, buy Yom Kippur, Traders Almanac, out there. And look, I think that has a lot to do with the timing of when Rosh Hashanah and Yom Kippur typically falls, and it typically falls in the September expiry through the end of the quarter window.
Right.
So you have this dynamic in the middle of September where people have to pay their income taxes, and so there's a large liquidity drain.
Craig, explain that. That's really important.
Yeah.
So this week, our company, we sent the IRS a large check. So think of like thousands and how many hundreds of thousands of businesses are sending. They're taking money out of their bank account and sending it to Uncle Sam. So the TGA, the Treasury General Account, goes up, but bank deposits go down. That creates a liquidity dynamic, correct?
Yeah, that's exactly what's happened. So the Treasury General Account went from 670 billion to 850 billion, over a 5-day period into September 15th. It's come back down a little bit. It's going to end the quarter at 850 billion. So what you have is folks making these tax payments, money coming out of bank reserves. You also had big Treasury auction settlements at the beginning of the week. So a lot of money has come out of bank reserves over the course of the last few years. What we've normally seen that money come out of the RRP, Reserve Repo Facility. Lo and behold, finally, that facility is basically at zero, right? So we no longer have that buffer on the reserve side. So the money, in order to pay bills, in order to pay your tax bill or for Treasury, needs to come out of bank reserves. And so, yes, it's the case. That doesn't necessarily mean that we have to fall or all risks get sold, but in an environment where banks are becoming maybe a little bit more cautious, that fall in reserves may lead to kind of some less lending over quarter end. There's some window dressing going on. We normally see the RRP rise in the last week of the quarter as banks.
Now, why should people care about this, Craig?
again, this is just about short-term liquidity drain, right? And so if there's a broad liquidity drain here over the course of the next couple of weeks with a market that is basically already at all-time highs, where systematic flows are largely all in, CTAs are basically 100% net long, vol control funds are back to kind of near high exposure over the last 5 years. And now we're through expiry period with the increased probability that fundamental news can matter over the course of the next couple of weeks. We've set up a situation here where we can have a market slide into the end of the quarter on deteriorating liquidity. The share buyback window starts to close, so companies are kind of moving to a blackout period. We've started to see some earnings pre-announcements and announcements that haven't been so great. Lennar today, Darden and Cracker Barrel earlier in the week. FedEx numbers were okay. The stocks were barely reacting. So not a lot of momentum there yet on the earnings side for the early reporters. And if we get some pre-announcements next week or the early part of October, we can start to throw some salt in the gears here on this equity bullishness at a time seasonally where liquidity is deteriorating and people are already kind of all in.
Right.
So.
Well, thanks, Craig. Have a great weekend with the family. Everyone, thanks for checking in. You can reach us at info@thebeartrapsreport.com for more information. Valentina, thank you, and everyone on the team, and we'll catch up next week.
Thanks, Larry.
Once again, thank you, Craig. Thank you, Larry. And thank you, everybody, for joining us. We really appreciate all the love and support you're giving the Lens. And we hope to see you next week. Remember that all the conversation that was had, you can see it on our Discord and our Bloomberg. If you're interested in joining us, remember you can reach us at info@thebeartrapsreport.com. And once again, don't forget to get your copy of How to Listen When Markets Speak